Are you struggling to find good entry and exit points when trading the markets? Or struggling to know whether a current move will continue or potentially run out of steam soon? Surely you've heard of technical indicators. But today I'm going to introduce you to a tool that few traders use correctly. It's the CCI, for Commodity Channel Index. So in this video, I'm going to teach you what the CCI is, how it works, and most importantly, how you can actually use it to improve your trading decisions. And I can guarantee you that you'll leave this video with solid tips and maybe even a new trading strategy idea to backtest. So make yourself comfortable and let's get started discovering the CCI. It's a technical indicator developed in the 1980s by Donald Lambert. Originally, it was created to analyze cycles in the commodities market, hence its name. But today it's used in all types of markets: stocks, crypto, forex, indices, basically anywhere there are charts. The point of the CCI is to measure the gap between the current price and its moving average over a given period. In short, it shows you how far the price of an asset is above or below its recent average price. The CCI oscillates around zero, and its values can go from very positive to very negative. Usually, thresholds of plus 100 and minus 100 are used to interpret signals, but we'll talk about that just after. As I said, the value of the CCI is calculated by comparing an asset's price to its moving average over a given period. The exact calculation is a bit mathematical, but don't worry, you don't need to be a math whiz to use that indicator. But if you want to shine in high society, let's say at a dinner among traders, here is the exact CCI formula. It's typical price minus the value of the moving average, divide all that by 0.015 times the mean deviation. And the typical price is simply the average between the high, low, and the closing price of the current candle. Then we compare that to a moving average over a given period. Usually by default, it's 20 periods. What you should remember is this: the higher the CCI, the higher the price is compared to its moving average. Conversely, the lower the CCI, the lower the current price is compared to its recent moving average. Here is what the CCI looks like on a trading platform. It's this oscillator at the bottom of the screen. And the upper dashed line is the plus 100 level, and the lower dashed line is the minus 100 level. Originally, when the CCI was invented, it was used to determine overbought and oversold levels, with the plus 100 line and the minus 100 line. Kind of similar to the RSI with the 70 and 30 levels. So when the CCI would cross above plus 100, this would be considered a sell signal. And when it would cross below the minus 100 level, this would be considered a buy level. And so on. Here you would sell, sell again here, and here you would buy here. And then again, here you had a buy signal, and here you had a sell signal. But just buying because the CCI seems oversold, or selling because the CCI is considered overbought, if you test such a strategy nowadays, frankly, you're not going to have very good results. However, something interesting that I've noticed is that very often when the price level that we have, when the plus 100 line is crossed, that price level, very often shortly after, it will be retested or broken through. And same thing with the minus 100 line. The price that we have when the CCI crosses minus 100, very often shortly after, it will be either retested or broken through. So let me show you a few examples here. Look, when the CCI line crosses plus 100 here, at that time, the price is up there, closed right here. And look what happens a few candles later. I said that very often the price is retested. So we have a retest here and once again here. We might have a pullback in between, but the price level that we had at the close of the candle that crossed plus 100 on the CCI, it's retested or broken through shortly after. Of course, this doesn't happen all the time, otherwise it would be too easy, but it's a phenomenon that occurs quite frequently. Here, look, once again, the price crosses plus 100 on the CCI, and here we directly have a continuation of the price. And when we have the pullback, we even have the retest of that level later. We have another example here. This is the close. Okay, no, this one is not reached again. So this one would be, we'll put it in red because this one didn't work. We directly had the reversal. Look here, price crossed minus 100 on the CCI, and very shortly after that price was retested and broken through. So this is another example of an interesting signal. Here we crossed through minus 100 and we directly had the continuation after. Here price breaks through the plus 100 level here, and a few candles later we have the retest of the level with a pullback in between and then a continuation. So I'm gonna keep doing this work and check it on the Nasdaq future NQ over the last 2 weeks or so. So there will be different signals. For example, when the CCI crosses above 100 or minus 100, when we have, like here, when we have the pullback before the price is retested, I'm gonna put that as orange because we have the pullback before the retest. So that would also be an orange signal because we have the crossover, but we have a pullback before the retest. This one would be a red signal because we had no retest whatsoever or continuation. The price reversed and never revisited our close price here. And when we have the direct continuation after the CCI crossover, I'm gonna put that in green. So yeah, we'll have red, orange, or green signals. All right, let's go. All right, so I've identified this setup over a 15-day period on NQ on the 15-minute chart, and it occurred 89 times in total. And out of those 89 times, only 9 of those times were red. That means that when there was a crossover of the plus 100 or minus 100 on the CCI, price directly reversed without retesting the level. That means that 89 or 90% of the time when the CCI reached plus 100 or minus 100, the price that NQ had at that moment was retested or broken through a short amount of time later. I found that it took usually no more than 30 candles. So in other words, when there was a crossover of the CCI, within the next 30 candles, the price that we had at the time of the crossover was retested or broken through. There are 27 orange setups here. That means that on this sample, 30% of the time there is a pullback before the price was retested. And the 60% rest of the time, price just keeps going for at least multiple candles before it reverses. But yeah, overall, here in this, like over the last 2 weeks, 9 times out of 10, the price was retested eventually. So I'm not saying this is a full strategy by itself, but at least it's food for thought for you if this is something that you want to elaborate or dive further into. Now, of course, we would need to add the risk management dimension so that the 10% of the time when price reverses, like when would we cut the losses? Also, like when there is the pullback, to go for the retest, when would we want to get into that pullback? Would we go on even lower time frames and try to identify signals? This is all down to your creativity, but I'm sure you can find something. So when you think about it, this logic is totally going against the original purpose of the CCI, because the original purpose was to use it as a point of reversal, whereas here we are actually using the crossover of plus 100 and minus 100 as a sign of continuation, either with the coming retest or the direct continuation of the move. And on a similar video that I recorded on our French channel, and I tested this setup exactly this way also on the Nasdaq, it was back in April. At the time, we had found that the setup on the sample I tested 84% of the time led to a retest or a continuation. Today it was 89%, so slightly better. But it's the same order of magnitude. Now, another way of using the CCI, which is not my favorite, but I've seen several traders use it effectively, is with divergences. Both regular divergences to identify potential reversals and hidden divergences to find entry points to get back into the trend. As you can see, there are a lot of divergences, and not all of them are clear and reliable signals of a true bottom or top occurring. But as I often say, not all divergences indicate a potential true bottom or top coming, but when there is an actual bottom or top occurring on the chart, at that moment, very, very often there is also a divergence. Do you see the nuance there? That means that if you can combine the CCI divergences occurring with another potential technical element that would add confluence that a reversal is coming, such as like potential support and resistance zone or supply and demand or whatever other element that you find reliable, that could add confluence and then increase the odds of a reversal or continuation actually happening, or pullback on a previously broken and retested level, or a fib retracement, or any technical element that you already find reliable. Okay, what we're gonna do now is backtest on the Nasdaq a trading strategy that trades all the divergences that occur, all the regular divergences on the CCI. So I'll prompt it like this. On a 1 hour chart, we'll say sell when there is regular divergence on the CCI, immediately followed by a red candle. And I'll say buy when there is a regular divergence on the CCI, also immediately followed this time by a green candle. For the stop loss, so this is our entry rule. For the stop loss placement, we'll say stop loss on the high or low of the candle that has the divergence, and we will test reward to risk ratio of 2R. So I'll just say TP at 2R. So this is a pretty simple strategy. As you see, we want to check if, like, trading all the divergences that occur on the Nasdaq on the 1 hour chart, if this is a potentially profitable strategy or not. So I'll start the backtest and we'll check out the results. Well, it's not so great. I forgot to mention that I backtested it from 2018 up until today, so that's 7 years of data. And on every trade, I risked 0.5% of the capital if the stop loss is hit. And obviously, well, it looks like a break-even strategy with no positive edge and no negative edge. The win rate is fairly low at 34%, and the risk-to-reward ratio is slightly below 2 because of fees. So yeah, this brings no edge whatsoever. So as we mentioned, not all divergences should be traded because it's kind of pointless to do so. Let's now try not with regular divergences, but with hidden divergences. So I'll copy the strategy and I'll slightly modify the rule. I'll say sell when there is a hidden divergence and buy when there is a hidden divergence, also followed by either a red or a green candle, depending if we want to sell or buy. So I'll start this backtest and we will see if it's actually better or not. Well, obviously it's not good either, but it's not bad. It's a break-even strategy, so it has no positive edge, but no significant negative edge either. So trading all divergences that we see on the chart is not a quality strategy, but as we mentioned before, if we can add more confluence by adding other technical elements when we see certain divergences appear, then probably we can isolate some of the higher quality ones and potentially bring the strategy in profitable territory. And you know what? I'll let you do that, because you can get started on upside.com right now for free. You'll find a link in the description below. At least, well, it took us barely 2 minutes to know that trading all divergences is not a good strategy per se. Alright, I hope this video helped you better understand the CCI and how it works, and I hope it gave you some potential strategy ideas that you can test right now. As for me, I'll see you in the next one.